To enter the world of financial crime, you need to know the secret playbook. Every criminal mastermind, from a drug lord with a mountain of cash to a corrupt official with a secret ledger, relies on the same universal blueprint. It's a three-stage framework: placement, layering, and integration. Every scheme you've ever heard of is just a new twist on one of these three steps. 1. Placement. This is where the mission begins, and it is your moment of greatest danger. You have a pile of conspicuous physical cash, and you need to get it into the legitimate financial system. The logistical problem alone is immense. $1 million in $100 bills weighs over 20 pounds. The goal is to transform that bulky, risky currency into a less traceable form, like a bank deposit, without triggering alarms. This is the moment your money steps out of the shadows and onto the financial grid, the first and most vulnerable move in the entire game. 2. Layering. Now that your money is in the system, you have to make it a ghost. The funds are sent on a journey through a dizzying maze of transactions, a financial blizzard designed to bury its origins. Think of it like a master chef creating a complex sauce. So many ingredients are added and transformed that the final product is impossible to deconstruct. This means shuffling money through multiple accounts, phantom companies, and across different countries, creating a mountain of false trails that make it nearly impossible for any single investigator to follow. 3. Integration. This is the victory lap. The laundered money, now clean and unburdened by its criminal past, re-enters the economy. It might reappear as the profits from a legitimate business, the sale of a high-end property, or a successful stock investment. At this point, the criminal can spend it freely, investing in luxury assets or expanding their empire. The money has been given a new, respectable identity. And so has the criminal, who now appears to be just another successful entrepreneur. That's the three-stage framework that underpins all financial crime. Now that you know the blueprint, we're about to dive into the specific tradecraft criminals use to pull it off, starting with placement. Before we get into the tactics, if you're finding this deep dive into the financial underworld valuable, hit that subscribe button and ring the notification bell so you don't miss what's next. Placement tactics. Let's dive into the tradecraft. To get dirty money into the bank without setting off alarms, you need a clever opening move: smurfing. Imagine you have a duffel bag filled with $1 million. You can't just walk into a bank. In the United States, any deposit over $10,000 automatically triggers a report to the authorities. So you break that $1 million down. You hire a team of foot soldiers, or smurfs, who take that cash and make dozens of small deposits at different banks and branches, all carefully kept below the $10,000 tripwire. A truly professional operation won't use round numbers. They'll deposit irregular amounts, like $5,891 or $7,235, to look like legitimate daily business revenue. The Smurfs themselves are often low-level players, taking a significant personal risk for a small cut. Banks now use sophisticated AI to hunt for these structured patterns, but criminals are also using AI to automate and disguise their smurfing activities, making it a constant cat-and-mouse game. Cash-intensive businesses. Some businesses are a natural river of cash. Think laundromats, car washes, cash-only restaurants. They are the perfect front. You purchase one of these businesses, and it generates real, legitimate revenue. Then, you simply co-mingle your illicit cash with the day's earnings. If your restaurant made $5,000 today, you add $3,000 of your dirty money and declare $8,000 in sales. This is called co-mingling. After you pay taxes on that inflated income, your $3,000 is officially clean. The art is to inflate the numbers just enough so that it looks like you run a very successful business, not a criminal enterprise. The key is choosing a business where inventory and daily sales are difficult to verify, making it harder for auditors to spot the discrepancy. Casino drop. You walk into a casino looking every bit the high roller and trade a suitcase of cash for a mountain of chips. This is normal behavior in a casino, allowing you to instantly convert physical cash into a casino's financial instruments. To make it look real, you'll gamble a little. Maybe you lose a small amount, but that's just the cost of doing business, a laundering fee. Afterwards, you walk over to the cage and cash out the rest of your chips. The casino will then give you official paperwork for your winnings, creating a perfect paper trail that explains exactly where your newfound fortune came from. While major casinos have cracked down, smaller transactions still slip through. This entire process has now gone digital, with criminals using online gambling platforms to deposit dirty money, place a few bets, and withdraw clean winnings. Foreign currency exchange. This is a simple but brutally effective way to muddy the waters at the placement stage. You take your illicit US dollars and exchange them for Swiss francs. A week later, you swap those francs for Singaporean dollars. With each jump across a border, especially in a country with lax financial laws, a new set of records is created in a new jurisdiction. By bouncing money across a few currencies, particularly those in stable economies with strong banking secrecy, you make the original source a nightmare for any single authority to trace. Layering tactics. Once your money is in the system, the next mission is to make it vanish. This is the layering stage, where you create a web of confusion to sever all ties between the money and its criminal source. Shell companies. First, you create a ghost. A company that exists only as a name on a piece of paper, registered in some faraway tax haven. It has no office, no employees. It's just a legal fiction designed to conceal the true owner, known as the beneficial owner. To make it even more anonymous, you can hire a nominee director, a professional stand-in who puts their name on the paperwork instead of yours for a fee. Then, you move your money into this ghost company, disguising it as a consulting fee or a loan. This was the core tactic of the Danske Bank scandal, where billions flowed through shell companies registered in places like the UK and the British Virgin Islands. Offshore zigzag. This is financial pinball. Your money doesn't sit still, it flies. From a bank in New York to an account in Singapore, then to Cyprus through a shell company in Panama, and finally landing in a European bank. Each transfer is a new legal and bureaucratic hurdle for investigators. Different languages, different laws, and different levels of cooperation between international law enforcement agencies slow any investigation to a crawl. By the time they get the international cooperation needed to follow the trail, the money is long gone, having hopped through a dozen different accounts. Trade-based misinvoicing, TBML. International trade is a colossal, chaotic system with an estimated 250 to 300 million shipping containers moving around the globe each year, making it the perfect place to hide money. In trade-based money laundering, you misrepresent the value of goods. For instance, you sell a shipment of cheap t-shirts to your own shell company overseas, but you write an invoice for 5 times their actual worth. Your shell company pays the inflated price. The money has now successfully crossed the globe, perfectly disguised as a legitimate commercial transaction. Customs officials can't check every shipping container, so if the paperwork looks right, the shipment sails through. Variations include under-invoicing, multiple invoicing for the same shipment, or phantom shipments where nothing is sent at all. Fake loans. This method is elegant in its simplicity. A shell company you control in one country lends money to another company you control in a different country. This loan might have 0 interest and no repayment date because it's not meant to be paid back. The loan agreement itself is a prop, a piece of paper created for one reason only: to justify the movement of money and make it look like a normal business deal. This was a key part of the Troika laundromat scandal, which used a network of fake loans to move billions and create a legitimate-looking paper trail. Round-tripping. Imagine 2 companies, one in London and one in Dubai. You own both. The London firm makes a large foreign direct investment in the Dubai firm. The money might be used to fund a fictitious project, and after a period, it's sent back to the London firm as profits or a return on investment. The money leaves as an investment and comes back clean. The gold bar example is another version. A company buys a gold bar from another company you own overseas. The gold may never even move, but the money does. A wire transfer for the sale is sent, creating a paper trail for a commercial transaction that only happened on paper. Cryptocurrency peel chains. In the digital world, you can become a true phantom. A peel chain is where you take a large sum of cryptocurrency from a single wallet and peel it apart, splitting it into dozens or even hundreds of smaller transactions sent to new micro-wallets. These tiny amounts are then bounced through various exchanges that don't require ID, often automated by bots. Finally, all the fragmented funds are brought back together in a new, clean wallet. The blockchain might record every transaction, but the sheer volume and anonymity of the wallets make it almost impossible to connect the final funds to their criminal starting point. Mixers and tumblers. For the final disappearing act, there are crypto mixers, or tumblers. These services are digital black holes for cryptocurrency. They take your coins and pool them with thousands of other users' coins, shuffling them all together in a chaotic storm. Then, the service sends an equivalent amount, minus a fee, to a brand new, clean wallet you designate. The direct link between your old dirty wallet and your new, clean one is broken. Services like Tornado Cash have laundered billions, including funds from state-sponsored hacking groups, leading to major sanctions from authorities. Integration tactics. After being placed and layered, your money is now clean. The final step is to bring it back into the world as legitimate wealth. Real estate splurge. Real estate is a classic integration tool. You use your clean money, wired from an anonymous shell company, to purchase luxury properties in global hubs like London, Dubai, or Vancouver. The property itself is a stable store of value. When you eventually sell it, the money you make is just capital gains. In places with opaque ownership laws, it's nearly impossible to find out who the true buyer is. This model became so prevalent in British Columbia, it was dubbed the Vancouver model, where money from crime was laundered through casinos and then poured into the real estate market, artificially inflating housing prices for everyone. Art and collectibles. The art market is opaque and prices are completely subjective, making it a perfect tool for integration. You can use your layered funds to buy a high-value painting in a private sale with no public record. Even better, the art can be bought and sold within free ports, ultra-secure warehouses in tax-neutral zones where assets can be traded anonymously and tax-free without the art ever physically moving. A few years later, you sell that same painting at a famous auction house. The sale creates a clean public record of a profitable investment, and no one can prove what the art was really worth in the first place. Precious metals. Gold is the original untraceable asset. It can be bought with clean digital funds, melted down, recast, and sold to dealers with few questions asked. It holds no memory. It's anonymous, easy to transport, and has universal value. Modern launderers can even use digital funds from their layered accounts to buy shares in gold ETFs and then redeem those shares for physical, untraceable gold bars, which can then be stored in a free port or moved across borders. Luxury vehicle fleets. This is a more niche but effective tactic. You use a shell company to purchase an entire fleet of high-end vehicles. These cars can then be resold over time for clean cash, with the sales appearing as normal business activity. Even better, the fleet can be used as collateral to secure a perfectly legitimate bank loan, injecting clean money directly from a reputable financial institution. The depreciation on the cars is just another small fee for the laundering service. Stock market laundering. This is a high-risk, high-reward pump-and-dump scheme. You find a little-known, thinly traded penny stock. Using multiple nominee accounts to hide your identity, you begin pumping money into it, executing trades between your own accounts to create artificial trading volume, and using social media to generate hype. As the price skyrockets from your fake activity, unsuspecting investors jump in. You then sell off all your shares at the peak, crashing the price, but walking away with what appears to be nothing more than a savvy stock market win. Life insurance buy and sell. This is a long-term, patient strategy. You take a large sum of your layered funds and purchase a single premium life insurance policy, often from an offshore insurer with less stringent oversight. This large upfront payment moves the money into a highly regulated product. After a few years, a required holding period, you simply surrender the policy for its cash value. The insurance company writes you a clean check, which now has a legitimate and unimpeachable source. Hybrid playbooks. The true masters don't rely on a single trick. They weave multiple tactics together across all three stages, creating schemes that are exponentially harder to unravel. Casino layer real estate combo. Here's a classic hybrid playbook, famously known as the Vancouver model. First, illicit cash is brought to a casino and exchanged for chips, placement. After some light gambling to create the appearance of legitimate play, those chips are cashed out for a casino check. That check is then deposited in a foreign bank account, layering, and the funds are wired to a shell company as a fake loan, more layering. Finally, that shell company uses the money to purchase a luxury apartment, which is later sold for a clean profit. Integration. This multi-step process successfully laundered billions and distorted the Vancouver real estate market. Crypto smurfing. This is a modern twist on an old classic. Instead of depositing cash in banks, criminals use a network of smurfs to make many small cash purchases of cryptocurrency from peer-to-peer traders or at crypto ATMs. This converts physical cash directly into crypto while staying under reporting thresholds. Once the cash is converted, the funds are blasted through mixers and peel chains to completely obscure their origin, layering, before being consolidated in a clean wallet and used to buy assets. Integration. TBML plus fake shipping. An even more advanced version of trade-based laundering might involve over-invoicing a shipment of goods while deliberately undershipping the actual product. The difference in value is where the dirty money is moved. To make the trail even more confusing, the criminals might then file a fake insurance claim for the lost goods, creating a second layer of legitimate-looking documents and an insurance payout to justify the incoming funds, effectively washing the money twice. Real-world flashpoints. These aren't just theories. They're the headlines of some of history's biggest financial scandals. Danske Bank's Estonian branch became a fire hose for dirty money. An estimated $230 billion in suspicious funds, mostly from Russia, flowed through this single small branch between 2007 and 2015. The scheme relied on a network of anonymous UK and British Virgin Islands-based shell companies. The bank ultimately pled guilty to defrauding US banks and agreed to forfeit $2 billion. The Wachovia case was shockingly simple. As much as $380 billion from Mexican drug cartels was funneled through the bank, mostly using bulk cash deposits from Mexican currency exchange houses, casas de cambio, and subsequent wire transfers. The bank simply failed to apply proper anti-money laundering controls and was fined $160 million, a fraction of the illicit funds it handled. The Troika laundromat was a masterclass in layering. It was a network of at least 75 offshore companies that moved around $4.8 billion. The scheme's linchpin was the use of fake loan agreements between companies within the network, creating a completely fabricated but legitimate-looking paper trail to justify the massive fund transfers. In Australia, police busted criminals running the textbook casino-to-real estate playbook. The scheme involved turning gambling chips directly into a portfolio of luxury properties, perfectly combining the placement and integration stages in a single streamlined operation. The now-defunct crypto exchange, BTCE, was a laundromat for the digital underworld. It processed billions for ransomware gangs and other criminals. A significant portion of these funds were funneled through crypto mixers like Tornado Cash, which was sanctioned by the US Treasury for its role in laundering hundreds of millions from hacks by groups like North Korea's Lazarus Group. The cat-and-mouse future. The fight against money laundering is a perpetual war. As soon as one loophole is closed, a new one is exploited. Regulators are getting smarter. They're using AI and machine learning to hunt for suspicious patterns that rule-based systems would miss. New laws like the Corporate Transparency Act in the US are aimed at unmasking the true beneficial owners of shell companies, making it harder to hide. The rise of central bank digital currencies could also create a new level of traceability, threatening traditional laundering methods. But the innovators of crime are always a step ahead. They are moving into the wild west of decentralized finance, DeFi, where there is no central intermediary to subpoena. They are using NFTs as a new unregulated way to transfer value. A criminal can buy their own NFT with dirty crypto, creating a record of a legitimate sale. They are exploiting online gaming economies where in-game items and currencies bought with illicit funds can be sold to other players for clean money, completely outside the traditional banking system. The game evolves, and both sides are now using AI to fight this endless battle. For those who found this tour of the financial underworld intriguing, consider subscribing for more deep dives into complex topics. Share in the comments which tactic you found most surprising, or if you know of any other clever methods that have come to light. The three-stage map makes the criminal playbook clear. Placement gets the dirty money into the game. Layering sends it down a rabbit hole of confusion to hide its origin. And integration brings it back home as legitimate, respectable wealth. The methods evolve, from cash-stuffed suitcases to algorithmic crypto mixing, but the goal is always the same: to make bad money look good. Authorities continue to tighten the net with new regulations and powerful technologies. But as long as there are vast profits to be made from crime, there will be endless creativity in hiding them. So, stay curious and skeptical. The next time a flashy building with an opaque owner goes up, or a quiet cash-only business seems unusually successful, it's worth asking, is it built on concrete and steel, or simply well-rinsed cash?